fiat money is the fuel for all bubbles. Money which was injected into the monetary system will kind of leak into real consumer price inflation, and that will obviously show up in commodity prices. Gold and silver could be the canary in the coal mine.
Please join us for our next live stream,
Sunday, October 13th.
at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be
Sunday, October 13th.
9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to our channel or have not already done so, please do subscribe, click on the bell to be notified on new updates, and do give us a thumbs up. If you like what we do, we appreciate your support. Our guest today is Mark Valek, who is partner of Incrementum AG, an independent investment and asset management company based in Liechtenstein. He co-authors the well-known In Gold We Trust report with Ronald Stoffle, a benchmark report on gold, money, and inflation. And we are delighted to have him here again today as our guest. Good day, Mark, and welcome back to SBTV. How are you doing?
I'm great. Hi, Patrick. How's everything?
Great. Glad you could be here. I know you're awfully busy there with Incrementum and your other projects, but we appreciate the time that you've given us. 2019 turning out to be a pretty good year for gold and silver. Both metals broke through key resistance levels. I think gold is now at 6-year highs and silver's gained some 30% before the recent correction. And it wasn't a typical case of sell in May. And I got to ask, were you surprised by the move in prices? And what do you attribute as the reason for the run up in gold prices?
Well, quite a few reasons, I guess, but mainly I think it is the change in monetary policy in the US. We've been writing about that quite a bit in our gold report, and we've been hearing about this normalization of monetary policy during the last years. So Fed was hiking slowly but surely, and they were tightening their balance sheet, quantitative tightening. And still up to Q4 2018, this narrative was actually, they were able to keep up this narrative. But then we had a big dip in the stock markets, and then they actually had to kind of readjust their narrative, still trying to stick to it as much as possible, not to lose face too much. So they talking about an insurance cut or perhaps two now, but nobody really wants to talk about the new easing cycle yet. But as time goes by, it's our opinion definitely that we are in a new easing cycle and that this credit cycle has turned, and it will probably get more and more obvious to people down the road.
Okay, yeah, I think the what's going on in the repo markets has been kind of waking some people up. But in the technical analysis chapter of this year's In Gold We Trust report, it said that if the gold price were to break through 1360 to 1400 USD per ounce resistance zone, the next target would be $1,800 per ounce. And the price of gold has pretty much broken through that resistance zone. How soon do you expect us to see prices heading upwards toward $1,800 gold?
Well, that is a medium-term, I think, observation. So we looked at the longer-term charts and medium-term charts when we made this assessment, and this technical line of 1360, 1380, which you mentioned, was pretty obvious. A lot of people were following actually this resistance, and in that case, technical analysis actually did work pretty well, because once we did break through there, it went up more or less $100 in a few days, a few weeks at least, and that's actually a picture example of a technical analysis which worked. So I think the next stop with $1,800 will take a few months. Obviously, could take longer too. But I think we need a trigger, a fundamental trigger that actually pushes gold prices higher. And as I already mentioned, I think that trigger would be, for instance, more and more people realizing that we are in an easing cycle also in the US dollar, and that yields and interest rates will go much lower also in dollars. We had a big collapse actually already on the long end in the US dollar yields. That was, I think, a big part of this year's market breakdowns of yields. So we have the 10 years almost, I think, coming from three-ish levels and going to like 1.7, 1.6. So that was happening in a pretty fast fast speed, and so long that was also, I think, perhaps also giving again a boost to the equity markets, because U.S. equities are up this year as well. So both assets, gold and equities, year to date have a good year, although gold is outperforming a little bit, and that's quite interesting, I think. Also, perhaps if I may mention that too, obviously we and most of the people always look at the gold US dollar gold price, but something that has been going on for quite a while, even before this year, is that we had pretty obvious uptrending momentum in the gold price in various other currencies. So that was to us already a good indication that we are generally again back in the bull market 1 or 2 years ago already, whereas in dollar, priced in dollars, this wasn't that obvious yet, but I think by now it's also obvious in dollars.
Okay. Yeah, I think you mentioned people are starting to see what's going on, but how about institutional investors? Have you noticed interest in gold from institutional investors now that the gold price has gone past that resistance zone pretty confidently?
I think so. I mean, I wouldn't say they're in a buying binge yet, but I think there are a few indicators which one can take as kind of as evidence for that. One, in our position, talking to people, like more anecdotal evidence, we are getting more requests to speak in front of people and for being invited to some kind of asset allocation for pension funds and so on. But that's slowly evolving slowly. To get a bit more hard statistical fact, I think it's quite interesting to just look at ETF volumes. I looked up the number, and it's been increasing quite a bit. So I think it was like in North America year to date till August, that is, I think ETFs increased 160 tons of gold, which is quite significant in North America, and 140 tons in Europe. So that's oftentimes the vehicle which some institutions use to increase their exposure to gold. So that also says, okay, people are rediscovering gold also from the institutional investor side. And that's obviously a good thing, an important thing, but still, in my view, it's not huge yet. So generally, the allocations to gold still are very small.
Okay. Based on the Dow theory and its three phases, the accumulation phase, the public participation phase, and the distribution phase, which phase do you think we are in at this moment?
Well, the Dow theory, and we mentioned that also in our report,
Yeah.
one has to perhaps first put a small caveat in front of that. It is a little bit of a simplified model, if you will. So it's interesting to think about it in these terms. But in reality, gold is a global asset, so it depends where you look at this and which region actually you're talking. From which perspective you get it on this. But I think we are perhaps past the accumulation phase, which is traditionally the phase one in the Dow theory, and between 1 and 2, somewhere there probably. So we are not yet in the third phase, in the distribution phase. Definitely not. We haven't got huge emotional and huge booms about gold. People. Like, for instance, recently, 2 years ago, you had this huge crypto hype. There's nothing compared to that, for instance, going on, which you would expect in phase 3. So definitely rule out that we are anywhere close to that. So this is somewhere between the phase one and phase two, I'd say.
Okay, during the last bull market for gold, do you recall what the distribution phase was?
Well, I mean, we had obviously the high, the last US dollar high was in 2011, and yes, the media coverage was definitely pretty high. And also, if you look at like some technical statistics, you had like RSIs pretty overbought and so on, and you had the price moving pretty fast above the 200-day moving average, so it was already pretty exaggerated. People like from the non-gold space say, okay, that was a bubble. It's always difficult to define what is a bubble. I wouldn't say that it was a bubble, but it definitely had a big media platform after the financial crisis. But I think that's not even close to comparing like in 1980, where I obviously was not around actively, at least in the investment sphere. But what I read, like from historic articles and from historic media, and also if you look at some kind of indicators and valuation and so on, valuation indicators, you cannot even compare that closely what happened 2011 to 1980. So I think that the last time gold was really in kind of phase three was end of 17, so beginning 1980. So that's a long time ago.
Okay. I just want to backtrack a little bit. I heard you mention pension funds. Europe in general, are pension funds funded or underfunded?
Well, I guess it also depends where you look at. It's a big topic, and Europe has different models where you have like kind of saving-based models, which is more like, for instance, in Switzerland, people really, so the pension funds really get money. So there are funds there. I think Switzerland has something around 800 billion Swiss francs in the pension fund system, which is quite something. But still, they're talking of being underfunded there. And then you have like the German or Austrian model, where it's basically funded by tax incomes. It's like the funds which are in the pension funds there are a fraction of the Swiss system. So definitely underfunded there. So I think it would be really good if people and or even perhaps states start saving more and investing more for their pension system. Generally, they're underfunded.
Yeah, okay. I just had to ask because I know in the U.S., I think a lot of it is very underfunded. But moving on to silver, now in that same technical analysis chapter of the report, I came across an interesting chart showing the long-term performance of silver versus gold using the gold to silver ratio chart that went as far back as 71. For our listeners who may not have read the report, can you give an overview of why this chart is showing that silver is a great opportunity today?
Well, gold silver ratio is a really interesting chart, and it's also interesting in my view because it oscillates on a very long term, but it oscillates between, depends how far back you go, say roughly 10 and 100. So 10 ounces of silver buy you 1 ounce of gold when silver is relatively expensive, and when it's inexpensive, it takes you you need 100 ounces of silver to buy you 1 ounce of gold, very roughly speaking. And if the gold silver ratio is close to 10, silver is rather expensive, and when it's close to 100, it's inexpensive. And we actually almost touched 100 again, and the 100 hasn't been touched for decades, in fact. So we made the assessments, not only we, but it's quite an obvious conclusion to draw that we are much more on the cheap side for the silver. So that's I think something which one can assess, and it actually seems to have been turning. So silver has been outperforming gold recently. Not tremendously, but it looks like this as if this trend has been broken, and that could be, in our view, also perhaps a leading indicator for inflation, which is a complete contrarian view right now. But at some point, it's our conviction at some point that this whole money which was injected into the monetary system will kind of leak from the asset price inflation into real consumer price inflation kind of, and that will obviously show up in commodity prices. Hasn't been so far, not in a broad sense at least, but gold and silver could be the canary in the coal mine for that.
Yeah. Okay. The In Gold We Trust report, it's mainly about gold. Are there plans to report or cover more silver?
There are, in fact, and so in our next In Gold We Trust report coming out in May 2020, we will feature silver pretty big time. And we actually tweeted out what kind of chapters would be interesting for the audience, and we received quite a few interesting proposals there, which we gladly are going to pick up on, a few of them at least, and quite a few readers said, please write more about silver, and I think it's a good time to do so.
Okay, a lot of people are going to appreciate that. Thanks for the heads up. Recently on Twitter, fiat money was your answer to the question, what is the biggest bubble right now? Can you explain your answer, fiat money?
Yeah, I mean, that's basically the framework where we're living and operating in. You know, fiat money is the fuel for all bubbles, right? So we had the real estate bubble, we had the tech bubble in the US, we had all kind of bubbles. We have now, in my view, pretty obviously a bond bubble, and a lot of people, and we also have been writing about an everything bubble. But what is the fuel for all these bubbles? Obviously, an inflating monetary supply, not only like base money, but also like the broad money aggregates have to keep increasing and have to keep inflating, and they're inflating, basically trying to inflate away the debt. But by that, it seems to be as there would be kind of inflating, paradoxically, a bond and a bigger debt bubble. So it's really a little bit of a vicious circle in my view.
Yeah, it is. But Mark, do you think that the current debt-based monetary system is sort of trapped in a cycle of money printing to keep the cycle of debt going and pushing the problem further and further into the future?
I think that's actually a core problem which is vastly underappreciated, that the characteristic of our monetary system is, as you said, it's debt-based. And it wasn't like that always. It was like was actually backed by gold. It was actually the basis of money was gold or silver or both. And that's, in my view, how I see it. That's like a positive asset. Gold is no one's debt. It's just like it has a positive value. But debt obviously is somebody's debt. And during the 20th century, we gradually transformed this monetary system from gold, from an asset-based monetary system to a debt-based monetary system. And I think this is really key and vastly underappreciated. And I really like you pointing out this fact. And I think a lot of people more should talk about this fact, because once you have debt as the basis of your monetary system, it starts to bring a lot of problems with it. For instance, if we say, for instance, if everybody would pay off their debt, there wouldn't be money. That's a very paradoxical fact about this monetary system. A lot of times, like conservative economists say, yeah, we need to reduce the debt and so on. In reality, that wouldn't even work. If one really paid off all the debt, there would be a huge deflation and no money left. as paradoxical as it sounds. So this debt-based character actually forces us to permanently increase the size of debt, and it also is then I think the reason why apparently we need this inflation. So central banks always said we need some inflation. I think the core reason that this system needs inflation. Obviously, humanity doesn't need inflation. Inflation is a transfer of wealth, and it's an unfair thing, and so on. And this is needed. With a debt-based money needs inflation. An asset-based money would not need inflation and does not need inflation. History shows that it doesn't need price inflation. So that's really the core of the problem, in my view.
Mark, one of the biggest news in recent days was the collapse of Thomas Cook, the world's oldest travel firm. It owed, I believe, 1.7 billion pounds of debt, which it could not secure a bailout from its lenders. Its collapse put some 20,000 jobs on the line. It's impacted several hundreds of thousands of travelers. Does it make you wonder why indebted private companies go belly up, but indebted nations seem to be able to get away scot-free? It's as if conventional economics does not apply to sovereign nations.
Well, the states have a big advantages relative to corporations, if you will, in terms of their ability to pay back debt. They can print money. And I mean, it was none other than Alan Greenspan, I think in 2011, who said it very frankly, the US will never go bankrupt because we have the ability to print money to always pay back the debt. Obviously, again, that's inflation, and that has other very bad consequences and very severe consequences. But Patrick, one can only do that trick for so long, and it has been going on for quite a while in a lot of countries. But I mean, we also see some other examples on this planet where also this trick is finite, and then if you do this too long, you know what happens. You at the end of the day you go into hyperinflation if you keep on printing more and more money just to repay the debt. But the state, you're right, the state has this tool to drag out this process and actually confiscate wealth via the inflation tax to be able to pay back the interest, at least, of the outstanding debt.
Yeah, I hear you. Are there any realistic solutions to the debt, or is it just simply mathematically impossible to deal with anymore?
Well, I think basically what the fiat money system does or is trying to do, or let's say the managers and central bankers of the system, is they try to reflate basically the system in the sense that we have a huge disparity between asset prices and say, for instance, commodity prices, real prices, So either asset prices decrease and collapse, or commodity prices actually catch up to the upside. So in the 70s, it happened. The later happened. So gold prices actually increased. You had stagflation, and you didn't have a huge breakdown, for instance, of stock prices. I mean, it was not a great decade for equity market investors, but it was a huge decade for precious metal investors, and that was kind of a realignment of these two things. And I think that would be, theoretically speaking, at least the only way out to kind of reflate and reprice gold at the end of the day, either by market, and I think the markets at the end of the day will do that, or even by edict. That's actually what happened in 1933 when they actually increased the gold prices from $20 to $33.
Okay. Europe. Given that the ECB has once again announced fresh stimulus to juice the economy, can you share with us your view on this and how is the excuse me, and how is the man on the street taking the ECB's plans? Is he happy? Is he upset?
Well, in my view, unfortunately, this QE, it's a silent thing. What I mean by that, I read like historic descriptions of the hyperinflation. The hyperinflation was actually loud because in Berlin and in Vienna, the printing presses were rolling 24 hours a day, so people could hear this inflation. Nowadays, this is basically invisible, and nobody really grasps what that means. That the ECB is buying assets with worth 20 billion a month again. I think where it's more obvious to people when it comes to negative interest rates, because then they are more directly affected by that measure. And for now, most of the savers haven't been affected in the sense that they had nominally negative interest rates. Most of the banks didn't charge any negative interest rates on their accounts because obviously that wouldn't go down well. If that once that happens, and I think it will happen, I think that could really trigger a bigger outrage, actually, especially perhaps among German people, for instance, because it's still a big saving country of savers. So once people really realize that their money gets less, nominally speaking, even, then I think that just goes against their general feelings of morality at the end of the day, right, and of fairness, and I could imagine that may really change some things at least in the political discussion, that this topic then gets more and more discussed slowly but surely.
Okay, you touched on negative interest rates. You touched on savers. Do you expect the next target for negative interest rates to also apply to these individual savers in the near future, as we just talked about, in an effort by the central bank to force people to spend?
I think that's the ultimate goal. They want to bring the currency into circulation. At the same time, I think the system, if you want to call it like that, is quite happy with reflating it via quantitative easing. So buying the debt of the states and buying the debt of the big corporations. They obviously have a huge advantage because they can refinance themselves to record low rates, which the state is enjoying, but also big companies are enjoying that. So if you have got access to the financial market, if you are a multinational company, if you have bonds outstanding, this is great for you because you have money for free. Very different. So for say the general public, also for small entrepreneurs. So that's the unfair thing about it. That's the wealth distribution part of it. But the people in charge, perhaps explicitly or at least implicitly, know that's not a bad thing that's going on. So they will not change this. The question is if there would be some kind of a political quest for like the people's QE, so where really people want to have this newly created money that could be obviously very popular if something like that comes up, probably from the left side of the political spectrum. I don't think that that's such an unrealistic case, but obviously if you think about the US, for instance, you would have to need a big swing to the left that such a measure would be discussed. But but that's pure inflation. The question is who gets it. Central banks don't want that. They're trying to still basically put the money into the channels of the banks and of the states. So they want to keep it as it is for as long as possible. That's my view, at least.
Okay. Yeah. So they're going to have to they bring on the negative rates and it starts affecting savers. They're going to have to figure out a way to stop those pitchforks from coming out. Um,
Exactly.
yes.
Yes.
Okay. Should be interesting to see what they're going to do. Let's talk about Bitcoin a bit. Do you think the erosion of trust in fiat money and the actions of central banks will drive more interest in Bitcoin as an alternative store of value or alternative currency?
I think so. I mean, that's exactly what I think the mission of Bitcoin was in the first place. So the inventors or the inventor of Bitcoin wanted to have perhaps a payment system, but also as a store of value. That's a big discussion. Will it be a payment system? Would it only serve as a store of value? But as people are scrambling for alternative money, people are already rediscovering precious metals again, slowly but surely, and also cryptocurrencies. Although most of the cryptocurrencies, I think, don't serve as a viable store of value. They're not really a lot of feasible alternatives in the crypto space. If you ask me, just from a security point of view. So Bitcoin obviously is the number one choice, and looks like it would stay that way for the time being.
How's the adoption rate of Bitcoin in Europe? Do you see it becoming a common payment option for retailers?
Well, a common payment option, I think, would be exaggerated. So yes, you had probably quite a few stores starting to accept Bitcoin and so on, but obviously that was happening already years ago. Right now, I think it's really more the store of value story. So and there are good arguments that that's actually enough, so to speak. If it would really become an easy payment, then that would increase the value of Bitcoin even more. But it doesn't necessarily have to do that. I mean, I get this question very often, like about from critics relative to the gold from the gold space. They said you can't eat gold, and you can't even pay your bread with gold, and you will never be able to buy. You will never have a scenario where you will need your gold to pay some bread. I actually agree with that, because I think even if you have a complete breakdown of a currency, which is not what I'm predicting, but if that happens, then I think gold, there will be other medium of exchanges which come up, and you will be able to exchange your gold into this new medium of exchange to a very favorable rate, probably.
Yeah.
So that's probably it served you as store of value for this transformation from the current system to whatever comes next. That's, I think, the beauty of gold. But you will not have to take out your knives and kind of carve down, slice tiny pieces of gold to pay some groceries for. That's ridiculous, if you ask me. And history shows that it didn't work that way. So even after World War II and so on, you had all kind of interesting medium of exchanges. Cigarettes were used as medium of exchange. All these kind of stuff. If you had gold back then, you could barter into the medium of exchange, and then you get the stuff you need.
Okay.
And that's the way. Sorry, and that's the way. Also, I think what could happen with Bitcoin. So that's the analogy. I think here works pretty well.
Okay. Before we wrap up, can you let our listeners know more about the cryptocurrency report, which you are also co-author of, and how is this report beneficial?
Right. So it's actually the crypto research report, if I may correct you on that.
Oh, yeah. Yeah.
And you can, everybody, it's like the little brother, little sister of the In Gold We Trust report, mainly edited and written by my colleague Demelsa Hayes.
Yeah.
But also we have other colleagues and people who are involved in this publication. So about 3 years ago, we at Incrementum made the strategic decision to cover the crypto space. Not perhaps because we are enthusiasts in this space, but just as we want to really cover also the gold space holistically, we came to the conclusion that crypto is something that is here to stay, and the crypto phenomenon will not go away. And it doesn't make even sense to just neglect it and say, okay, that's all a big bubble and so on. A lot of people in the gold space think like that. We think that it will potentially become more and more part of even like the official monetary system. And I think the indications were already confirming our view quite a lot. For instance, that the IMF and so on is thinking about like crypto state money. Obviously, one has to distinguish crypto money from the state versus kind of private or decentralized crypto money like Bitcoin. And now recently this year, the big news in the crypto space was Facebook's Libra. That's perhaps a third potential category of money emerging, corporate money. Yeah, so we're gonna see how that ends, if that will really take off. But this technology basically gives all kind of entities the possibility to experiment with money. And yeah, we're covering all these kind of developments in our quarterly publication, Crypto Research.report. You can download it and you can subscribe. And we are trying to also have a similar style in our writing, like in Gold We Trust report. So a little bit of entertaining style, but also obviously facts and statistics, charts, and all this stuff. So people are receiving it very well so far. And as I told you already, I really like the intellectual challenge, thinking about these developments and trying to stay on the ball as good as we can, and trying to inform our readers as good as we can. So that's basically our mission on that.
Okay. Where can the viewers download the Crypto Research and the In Gold We Trust report, and are they free?
Both reports are free. You get them at ingoldwetrust.report, one word, ingoldwetrust.report, and cryptoresearch.report. So these are the URLs for those.
Okay, and people can follow you on Twitter, correct?
It's at Mark Valek.
Okay, we'll do. We'll pass that on to our viewers. And Mark, it's been a pleasure speaking with you. We thank you for coming on the show, and hope we can do this again sometime.
Patrick, always good to be with you, and looking forward to next time.
That was Mark Valek from Incrementum AG and the co-author of In Gold We Trust report. More of his insights on precious metals and the global economy, please visit his website, www.incrementum.li. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content, and do also check out the SBTV podcast on iTunes and Spotify.